Members of Congress have been loading up on UNH over the past few weeks. This includes Marjorie Greene, who's known for timing market bottoms. She's made 2x gains year to date in both AMD as well as Palantir. But the big question we need to ask when considering this company is the industry as a whole truly uninvestable right now? If we look at UNH, in fact, in regards to the wider market, the S&P isn't correlating to the stock. Many companies are up and very significantly, and yet UnitedHealth, whilst it has recovered slightly, is down very significantly, more than 30% this year. So the question that we want to ask, is a 2x reasonable for the stock in the short to medium term, and why October 13 could be the turning point that pushes it towards all-time highs? So let's break it down. We'll also get into our valuation today. But one thing we should consider, there aren't many companies that have had as much negative news as UnitedHealth. We're talking here, word is that they secretly were paying nursing home to reduce hospital transfers, even told medical staff to change some patient status to do not resuscitate. And we know time and time again in 2025, the Department of Justice is investigating this company. That is what we have been hearing from the Wall Street Journal, and it does cover a few different elements. Now, if we take a look at the company's earnings, it hasn't been the greatest, with one of the largest reasons being higher than expected medical costs. And what they've had to do in turn is cut their outlook. Not only that, but in 2025, they also did in fact suspend it. So quite a lot of information that we need to incorporate when we do consider this company, but very interesting to note that in the latest quarter, this was one of the positions that Warren Buffett did make new in Berkshire Hathaway. Something, yes, worth considering. He wasn't the only one. In fact, we have billionaire David Tepper, amongst others, adding quite a significant portion, makes up around 12% of his portfolio. We have contrarian investor Michael Burry, a new position, around 11%. And whilst Warren Buffett's name is always the first one on the headlines, it is of a smaller degree. Will be interesting when we get Q3 results to see whether he continues to load up, but it's also very important to note here that we don't know what his average cost is, so he could still be in the red. Will be important to note this new quarter that does come up, if he is continuing to add, showing a real signal that he believes this one can rebound, and very strongly. Now, we also have word just in the last few days, some positive news in fact, that the new CEO is talking to those close with Donald Trump, and they're really trying to rectify some of these issues that have come out, and they believe talking this through with the administration is one step in the right direction. And we also noticed last week they actually reaffirmed their outlook for 2025. They're projecting at least $16 per share. Now that is quite low. What will be interesting to note is in the next quarter that we're going to discuss, if they can show signs that they're going to be able to blow right through that, then this really could see the company easily in the $400, maybe $500, and revenue will be another one that analysts will be keeping an eye on. And because of all this news that has come out, we've seen the continuation of price targets moving in the right direction. We have increases, Troy Securities up to 365, UBS 378, as well as Bernstein 379, and these are just a few of many that really believe UnitedHealth could be on the up. If we look at the company overall, they're down 40% in the last year. Year to date, down around 31%. And over the last 10 years, we're going to compare that to both QQQ as well as the S&P. As of now, though, a very strong rebound from 52-week lows at $235, but still quite some way from 52-week highs. Now, both Seeking Alpha and Wall Street do consider this company a buy. 4.29, 4.03, not too bad, we would say fairly respectable. And whilst we are looking at this on a forward P, and it does look a little bit daunting, we're talking 29, that is above the 5-year average of 19.9, so yes, off the bat we would say potentially overvalued. remember they have cut their outlook and this is potentially going to be a one-off, so if they do increase it in the following years, we could see this drop dramatically below the 20 mark. Yield is also above 2.5% versus 1.4. This in fact is what we typically would call an undervaluation signal, and it's worth highlighting given the disparity between the yield and the 5-year average that the dividend does look to be safe, a score of 80, as well as an increase in June of 5.2%. Remember, on the channel we want to see a bare minimum of 4 just to keep up in line with inflation. The other valuation perspective that we like to look at is the blue tunnel, which correlates to the intrinsic or fair price. First things first, it has been decreasing from May this year. Not a good sign. We always want to see this going up, increasing the trajectory time after time. But we also see it now in the upper end of the blue tunnel, another reasonable, potentially moving in to an overvaluation signal. But as always, remember, not in isolation, and we will be running this through our own valuation process. The other thing is, when we zoom out to the last 5 years, this one more often than not trades at a premium, although we do notice a stretch in the reasonable signal, and in 2025, investors have had the chance to buy this severely undervalued. As always, make sure notification bell is on, you are subscribed, and when we see high quality companies trading severely undervalued, we will let you know. Now moving into their earnings, out of the last 4 quarters, they've actually only beaten off 2 of them, and the most recent one was a 37-cent miss. The next 2 quarters, they're projecting double-digit decrease to the earnings per share, with really Q2 2026 being where they see it turn positive. Now earnings per share projected $18, this is actually 2026. If they hit that, forward P will come down to 19.5, although you could argue new CO is in place, potentially some sandbagging, and if they do hit right through this, we are talking about this forward P coming much lower, and the next earnings is going to be on the 13th of October, so we're talking around 4 weeks away, of which, as we highlighted, for the full year EPS estimate sitting at $16.24. If we have a quick look at the projections moving on to the next few years, one thing we notice, if they do hit that 2025 estimate, that is a 41% drop from 2024. $18, as we said, into 2026, an 11% increase. But the real key takeaway here is they are anticipating moving forwards into the next 10 years for earnings per share to increase at a double-digit rate. Always a great sign, especially for a company that some people would argue is severely undervalued right across every single metric. And it's also one that more often than not does show beat after beat in terms of the earnings. Last few, bit of a struggle. But if we solely look at the earnings per share, last 2 years, so we're talking 8 quarters, they've beaten 8 out of 8. In terms of revenue, we notice 6 beats, 2 misses. Not a bad track record at all. And we can see here, in terms of the surprises, looking fairly decent. What this really tells us, going all the way back to 2009, they actually are a very consistent company. Yes, we're not seeing massive surprises, not a massive beat, but overall it tells us they are incredibly consistent. If we do the exact same to the revenue, well, we notice most recent annual accounts, they did in fact miss. If you want to see another one, you'd have to go back to 2019. And in terms of the disparity between the estimations and what they reported, again, not too dissimilar. So honestly, in reality, we would say, yes, never look at historical performances. It doesn't tell us anything about the future, but going back to 2009, this is a very consistent company. Now, it's also one that the institutions themselves like, 88% ownership, selling $45 billion in just the last 12 months. They bought around 50% more at $65 billion, and they've bought around 40% more in the most recent quarter, $14 billion buying, $11 billion selling. If we want to see the reversal of the trend where they've sold more than they bought, you'd have to go to Q1 2024, and this really highlights when we take a look at each quarter, more often than not, very often in fact, institutions are net buyers of UnitedHealth. And like super investors, like members of Congress, this is one they have been buying in 2025, both quarter 1 and quarter 2. But we also have to bear in mind growth not looking good, at least in the shorter term. They get an F overall, 10% last year, expected around 8% this year. Now on both accounts, not too dissimilar from the sector overall, a little bit lower than their historical. So what we are noticing, on average, this company grows their top line 10% year on year. But the thing that really lets them down is earnings per share, estimated in the next 3 to 5 years to not grow at all. When you just compare that to the sector, much higher at 10, and likewise their own 5-year much higher at 13. So it's good to see they get an A+ on profitability. Gross margin lacking at 21%, sector well above at 60, their own 5-year above, so not something we really want to see. Bottom line though, 5%, much better. Even with the lower gross margin, they're managing a better net income than the sector, which is pretty much flat and not too dissimilar from their own 5-year average. So bear in mind, this industry as a whole, their bottom line margins aren't the greatest. They are working on some very small numbers, and the cash this company generates from operations has actually been increasing, 29 billion on a trailing 12-month, above their average of 25, and a bit disappointing to see that the sector overall actually burns through cash, negative 11 million. So you really need to be careful about which companies you are buying in this sector overall. Now we can also look under the hood at some of their metrics. First one, free cash flow payout, as they do pay a dividend. As always, we tend to look at it over the earnings, which is susceptible to manipulation by management through accounting. We want below 60%. That is what we get every single year, projected to increase, but still below our threshold at 47%. And then we look at the free cash flow per share. As always, consistent growth year on year. We get it for the most part, although it is expected to drop over the next 12 months from $23 to $19. And sales growth, not too bad for a company in this industry, nearly double digit every single year, trailing 12 month, highlighting that as well, sitting at 10%. Now we'll come back to the total sales in a bit, but in terms of shares outstanding, we love companies that return excess cash to investor pockets. Nothing too much to really write home about. We see a small drop on a trailing 12 month. One thing we would say though is it will be interesting to see if management in this next quarter really do a share buyback authorization program, just because it does look like the share price is a little bit undervalued. Now ROIC, minimum 10% or more, one of our favorite metrics. Give us faith, management are able to effectively allocate their capital. We see it, not only that, but very consistent. Always a great sign to note. And then we move on to margins, which if you just look at it in isolation, you would say not great. But remember, it is actually higher than the sector overall, and this is what is to be expected, sitting around 7 to 9% in the last 10 years, and free cash flow margin pretty much straddling around that minimum 5%. Finally, net debt to EBITDA, very important, correlates to both dividend safety, balance sheet strength. Below 3 is what we want. Numbers you see, the number of years it would take UnitedHealth to pay off their debt, net of cash on hand. 1.73 expected in the next year, just something to keep an eye on given that it is expected to increase, and we will touch upon the balance sheet as well. But as always, because it does correlate to balance sheet strength, definitely a metric to always look at. Now, how does the company compare against the S&P and QQQ? Well, over the last year, very obvious to note, massive underperformance, negative 40 on both accounts. The other two ETFs are in fact up double digit. That's also reflected when we look at the last 5 years, although they are up 23%. S&P up nearly 100, QQQ 118. But over the last 10 years, very interesting. After the slight run UnitedHealth has had, it is now pretty much in line with the S&P in the last 10 years, although we do know QQQ has massively outperformed. So one question I would like to add is, why would someone consider investing in UNH when QQQ has massively outperformed in the past, especially if you believe AI is going to continue to drive tech stocks moving forward? And then the other quick thing to do is look at how it compares against others in the sector. Is this an isolated issue or one that we are noticing across the board? And pretty much every single comparison here is down, and in fact significantly. Not great if you were heavily concentrated in this 12 months ago. Over the last 12 years, the conclusion does remain the same, not great at all. And over the last 10 years, again, pretty much the best one here was UnitedHealth, which as we highlighted, just about sits in line with the S&P overall. Now we are talking about a huge company in the US. It does produce a massive amount of revenue year after year. In fact, we can see it more than double from 10 years ago, 157 billion, to now sitting at 400 billion. Question we always like to consider with companies when we do an in-depth look: does the bottom line follow suit? Is there consistency? And the answer is yes for the large part. Up until 2024, it's gone from 6 billion to now sitting at 14, although a significant drop from 2023. Great to see here that on a trailing 12 month, it is expected to pick back up and quite significantly. The other thing we like to do is a quick health check, total cash versus total debt, which has gone up from 11 billion, now sitting at 29, so pretty much a 3 times increase. Question is, how does that compare when we do a health check against total debt? Because one number here in pure isolation is not going to give anything away. Now, like we noticed with the cash, total debt also increasing. We're talking more than double from 32 billion, now sitting at 80, and actually it is superior to their cash balance, which is why the net debt to EBITDA was sitting near the 2 mark projected. Again, definitely something we would say to keep an eye on, especially given the total debt levels are increasing year after year. Now, before we jump into our valuation, just to let you know, we have released our latest free weekly article. We drop one every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's going in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, our intrinsic value, as it has most recently done for UNH, consists of 2 different values. We're going to run through each 4 of these models very briefly before explaining our overall conclusions. Now, the first model that we have is Graham's valuation. EPS projections for this full year, growth rate as we highlighted as 0, and the AAA corporate bond yield, giving intrinsic price $110, our first signal which comes to overvaluation. Now, we do show them separately, so if you do want to just use a few of these models yourself, that is up to you. Then we move to the multiples valuation model, companies in a similar sector and size, average PE multiplied by the EPS to give us our next intrinsic price, another overvaluation signal, before moving on to the dividend discount model. So we have the growth rate year on year, average 12%. We want to be a lot more conservative, especially given the most recent increase, 5.25, indicating another overvaluation signal, but not too dissimilar from the current market value. We then move on to the DCF model, where we have the growth rate moving forwards estimated at 5%. Now we have free cash flow year on year, and using the growth rate and discount rate, we get the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, giving us $550. Bear in mind, for those that are interested and solely want to look at this model, on a reverse DCF, you can see right now, baked into the price is no growth at all. Some people may see that already and believe it is severely undervalued. So we have 2 values here. Firstly, the intrinsic price, which is based on all 4 models. This is if you do believe the issues the company is facing is for the medium to longer term. If you believe that, with the current price at $353, given it is above that, there's no margin of safety. In fact, we're saying it's trading at an 18% premium. Now, what we would typically do is we'd start off with a 10% MOS. We'd execute on that by, in fact, if it met our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe this model to be most appropriate, then a 10% MOS would be a buy at 269. At 20%, it would be a buy at 239, which was near enough at the 52-week low, and at 25%, a buy at $224. Now remember, as always, you can grab a copy of this model by clicking on the pinned comment below, run with your own numbers, whether it's for UNH or any others. And Wall Street, on average, whilst we see some analysts like Forbes believe this to be $600, overall the value does get to $375 into next year, indicating 6% upside. Now, the other valuation, solely looking at the discounted cash flow model and the dividend discount model, gets to $444. Unlike the prior method, instead of trading at a premium, we're now seeing a 21% margin of safety. For those that are interested and want to see this at 25, then a buy at 333, at 30% around 311, and at 35 sitting around the $289 mark. So let us know overall about UnitedHealth. Where do you see this company? Do you believe the first method to be more appropriate, maybe the second one, and whether you believe this company right now is a buy, hold or avoid. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.